Hello, everybody, and welcome to another exciting video with Ignatius L. Jackson, CPA. That's my name. Don't worry about it. No, I'm just kidding. Thanks for tuning in and appreciate everybody joining us. And wanted today to talk about financial statements for businesses, okay? And some financial statement basics to maybe give you some understanding of what you're looking at. You know, you might get these statements from your accountant from time to time, and you're probably like, what in the heck did they just send me? I don't know.
What the hell is this?
It's like Greek, Latin language of some sort. And so we want to kind of help you to understand some of that. So today we're going to talk about some of the things to consider and think about when you're looking at financial statements. So go ahead and stay tuned. We'll be right back in a second. All right, and we're back. Thanks for tuning in again, as I said, and staying with us and following. Hopefully you subscribe, like, and share the channel with your community and your people. We really appreciate any assistance in getting more subscribers, followers, and likes and all that great stuff. So thanks in advance. All right, so today we're talking about financial statements. So financial statements are composed of these items: balance sheet, income statement, statement of stockholders' equity, statement of cash flows, notes to the financial statements, sometimes supplementary information, and sometimes management discussion and analysis if you're filing with the Securities and Exchange Commission, okay? Most small businesses don't file with the Securities and Exchange Commission unless you're doing a Regulation CF raise or a Regulation A+ raise where you do have to file some reports with the SEC. That's usually the only time that you would have to worry about management discussion and analysis, but there's various companies out there that help you to create all that. That said, this is the general composition of a set of financial statements, okay? Each component is really important. The balance sheet can sometimes be referred to as a statement of assets, liabilities, and members' equity, or net assets. Statement of financial position is also referred to if you're a nonprofit. The income statement can sometimes be referred to as a statement of operations if there's no income and it's a loss for the year, or it could be referred to as a statement of activity for nonprofits, okay? The statement of stockholders' equity can be referred to as members' equity or owner's equity, depending on the type of business that you are, or if you're a nonprofit, the statement of net assets is what it's commonly called, okay? And the notes to the financial statements are not always required for a business, but if you're following US GAAP, then they are required at least annually to be included as a part of your financial statements, okay? But you don't necessarily do them every single month. All right, so that's kind of in a nutshell what financial statements are made of. Now let's kind of dig into, you know, the nitty gritty of what they are. All right, so we'll first talk about the balance sheet. The balance sheet is basically assets on one side, okay? On the other side, you have how you purchase those assets. You purchase those assets with either debt, which is liabilities, right? Or stockholders' equity, which is you as the owner of the business putting money into the business, or other owners. You can have multiple owners, not just yourself, right? So those are the two ways that you finance basically your assets. Your assets are like vehicles, houses, furniture, computers, that kind of stuff, okay? Software that you might have created for the business. Those are all assets, but you have to pay for them somehow. And sometimes in order to pay for them, you use liabilities or contributions from owners. Additionally, on the asset side is your cash balance, okay? So if you have enough cash in the business to cover it, then maybe you don't use any liabilities or stockholders' equity, you just use the cash that's available inside the business. But usually to get cash into the business, it's either through stockholders' equity or liabilities, all right? Important to note that balance sheet is as a point in time. So what that means is at that point in time, that is what your assets are, your liabilities are, and your stockholders' equity are, okay? It includes all activity to date, including activity from previous years, okay? So usually when you look at financial statements, they're for a year at a time, or a quarter at a time, or a month at a time, okay? That's usually the time periods that you would look at financial statements over. And when you do that, you know, they, so for the profit and loss statement, it's just for that period. Okay. It's not as of a point in time and doesn't include everything to date. It's just as that period for the income statement when you look at that in the statement of stockholders' equity. Okay. So just some things to kind of think about and consider as you're looking at the balance sheet. Very important to understand what this means. Balance is called a balance sheet because assets always have to equal your liabilities plus your owner's equity or stockholders' equity. If it doesn't, your financial statements are wrong. That's like a first thing that all accountants look for. It's a no-brainer. These have to equal. The equation is called the accounting equation. It has to work. If it doesn't work, something got screwed up somewhere along the line. Okay. Types of financial statements. I want to kind of talk about the types of financial statements that are out there. Cash basis, modified cash basis, tax basis, accrual basis, has two different versions, US GAAP and the SEC related version. There's actually a third version, which is for governmental accounting. Nobody really uses that are my clients, so I won't even worry about talking about that. Okay, so cash basis basically means there's no assets on the balance sheet, there's no liabilities on the balance sheet. All you have is cash and your equity. That's it. Okay, the money you put in and your equity. Modified cash basis, you have some accruals. Okay, you have fixed assets capitalized, for example. You might have some liabilities sitting on the balance sheet for like payroll, for loans that you might have, things of that nature. Okay, so you have a few things that you put there, but you don't put any receivables usually, and you don't put any payables usually. It's usually going to be more long-term assets that you would put inside of a modified cash basis set of financials. Okay, tax basis financials sounds exactly the way it is. Matches your tax return basically. There are certain things on a tax return that are permanent differences that will not show up on, or that, do show up on your financial statements, but will not show up on your tax return. So there will always be that kind of a difference there. But for the most part, your tax basis financials will match your tax return and correspond to it. Okay, so if something gets recorded as an asset on the tax return, it gets recorded as an asset in your financial statements, et cetera, et cetera. Okay, so pretty straightforward. That's what tax basis financials. Tax basis is what I would say 90% of my clients follow. Okay, most of them do not do US GAAP. They don't do cash basis or modified cash basis. Most of them do tax basis. Okay. Accrual basis is the creme de la creme. It's like that one that, you know, if you're going to file with, you know, certain investors, they might ask you for it. If you have bank covenants, they might ask you for US GAAP financials. What this means is you have to record things like receivables and accounts payables and accrued payroll and, you know, prepaid deposits and all kind of just crazy stuff. So US GAAP is the most complicated version of accounting, and it's the most costly to get done when you go to a CPA or an accountant to get help. So don't plan on having a cheap engagement if you want to use US GAAP financials. Tax basis or cash basis is going to be a lot cheaper if you can justify doing that versus doing full accrual accounting. Okay. Certified public accountants, such as myself, can perform certain services for you. We can do bookkeeping and preparation work. We can do compilation work. We can do review work, or we can do audit work. Okay. Bookkeeping and preparations, exactly what it sounds like. It's very straightforward. There's a lot of people who do that are not CPAs, but there are quite a few CPA firms that also do some bookkeeping and preparation. Okay, so compilation work, you have to be a CPA to do compilations, reviews, and audits. Okay, in pretty much every state. In order to do those, you have to be a CPA and to sign the report. There's laws that prohibit other people from doing it. Now, for compilations, reviews, and audits, there's different levels. So a compilation is the lowest level. There's no assurance. We basically take what you give us, help you to present it in a way that looks presentable, make sure that there's nothing that stands out that's super, super outlandish, right? and then it's done. Okay, so we don't put a lot of effort into those. That tends to be very inexpensive to get a compilation done. I would say on average, probably between $750 and $1,500 to get a compilation done. Okay, and that's for each year. A review is a little more complicated because we're giving a limited assurance, and we're basically saying we reviewed enough information to be able to say that we're not aware of anything that is materially misstated. Is primarily made up of inquiries and analytical procedures over the numbers, okay? And then if we see something that stands out or that seems off, we will ask for more supporting documents to support the review. The review usually costs, depending on the firm, between $2,000 and $5,000 typically. I don't usually see them much higher than $5,000, just because they are fairly straightforward to do, okay? An audit. The most complicated thing you will ever go through, if you ever have to go through an audit, is sucks. All right, we have to look at detailed documentation for like your revenues, your expenses. We have to confirm your bank accounts. Sometimes we have to confirm your receivables if you have a lot of those, and it's a significant account. We have to do all this extra planning and the thought process and this and that. We have to look at your controls. An audit is a pain. Okay. And it is also the most expensive version of a search, but it's also the highest level of assurance. So there's certain lenders and places that might require an audit, but just keep in mind, if you plan on getting an audit, the lowest I've seen that of places that actually know what they're doing is about 5,000. The highest is usually about, it can go real super high for public companies. I would say on average though, for a smaller business, you're probably looking at about 10 to 15,000 for an audit. So, and that's again for each year. So keep that in mind, as you are thinking about what you want to do. It's definitely something to consider and think about. If you don't have a requirement from a lender or someone, doing a compilation or review probably is going to be better than trying to do an audit. Okay. Types of financial statements, lender considerations are something to think about. Taxes versus bankability, right? If you take a bunch of deductions, it lowers your taxes, but it may not get you to the point where you can finance a loan. So, excuse me. So you have to always kind of think about that and think, all right, do I really want to take all these deductions and save a bunch of money, or do I want to be able to go get a loan next year? If I'm right on the cusp of my income or whatnot, maybe I pay a little extra in taxes by not taking all my deductions for a particular year. All right. Now, technically, you're supposed to take all your deductions, so I'm just forewarning you. But I know there's a lot of people who don't, just because they need to be able to go get a loan for a mortgage or something like that, where they look at your tax returns. Okay. Sole proprietor versus corporation, something to think about as well. They like corporations a lot better than they like sole proprietors, just because it makes it seem a little more legitimate. So having an entity of some sort, things like that, as a business owner, if you're trying to go get loans or lines of credit, definitely helps. Having EIN for the business helps. Having business credit for the business, a history there helps. So definitely something to think about. Additional considerations, if you don't want to go get a loan, would be crowdfunding. Republic, WeFunder, Start Engine. I actually invest on all those through my self-directed IRA, of course. Self-directed IRA and my solo 401k, by the way. I have both of those. So, it's definitely something to think about and consider, okay? Debt versus equity. You can raise either way when you do capital raise on crowdfunding campaigns. So definitely something to think about. It's becoming more and more popular. You can raise up to $5 million through regulation of CF. But you do have to get an audit if you're going to do that. So something to think about, but it's a nice way to be able to utilize, the general public to raise some dollars and not be, committed to having to go after some big angel investor or something like that. Okay. Private lending is another option. There's a lot of lenders out there who lend your business money. Hard money loans, friends and family, all considerations to think about if you're trying to raise some capital. Okay. So anywho, that's a little bit about financial statements and kind of their importance and their use. The profit and loss statement is pretty key and essential as well. Obviously, it shows your net income and how much money you're making off of the operations each year. So, pay attention to those things. Don't have a bunch of accounts on your financials is my recommendation. If you're doing your own bookkeeping, you should not have an account that only has $5 in it. That's silly. All right. So put it into miscellaneous or, something else. Your accounts should generally have a decent amount of money flowing through them each year. Otherwise, it doesn't make sense to have it. Just throw the expense into miscellaneous and, have a smaller number of accounts that, makes your financial statements look presentable to a bank. So anywho, thanks for tuning in. Hopefully y'all enjoyed this. Definitely, like I said, leave some comments and let me know what you think. Or if you want me to go more into detail on some of this stuff in another video, let me know as well, because I'm trying to, kind of gauge what people are interested in and what you want to see. So definitely let us know and give us some feedback. Okay. Well, hopefully everybody enjoyed the video, like I said, and we'll be back with you with some more information and awesome stuff in the near future. Hope you have a good day.